Welcome to the weekly deep dive. If you're anything like me, you probably feel like the amount of information coming out at us right now is overwhelming. Between the AI breakthroughs, the stock market swings, crypto, and the general economy, I found myself reading endless newsletters and listening to podcasts, but barely retaining any of it. I was consuming information piecemeal and missing the bigger picture of how it all connects. And this podcast is thus my solution to that. Every Saturday or so, sometimes things go awry, but my goal is simple with this, right? It's to practice articulating complex ideas, to ground myself in what's actually happening, and to help you connect the dots without having to read the entire internet. This is a passion project. So, having said all of that, let's get into this week's synthesis. Usually when we talk about medical diagnosis, there's the expectation of absolute precision. It's like engineering. You break your arm, you go to the hospital, the x-ray shows that stark, jagged white line across the bone, and the doctor just taps the screen and says, well, there it is. That's the problem. It's binary. It's clean. Psychologically, I think it's incredibly comforting. We as humans desperately want our problems to be visible and cleanly categorized so we know exactly how to fix them. But then you step into something really complex, like the world of neurodevelopment or systemic autoimmune diseases, and suddenly that X-ray machine is utterly useless. You are staring at a diagnostic landscape that is entirely murky. You have symptoms that contradict each other, treatments that make things go worse before they make them better, and no single test that just gives you the answer. I want you to hold on to that image of the broken diagnostic machine, because today we are taking a deep dive into the global economy, the technology sector, and the geopolitical landscape of April 2026. Every traditional diagnostic tool we have for the market is completely malfunctioning. The traditional indicators are blinking red, green, and purple all at once. So, why this is my mind is blown at the moment, because what exactly is this? It's pretty much exactly why we can't tell and just look at a single chart right now and decipher the world. The goal of this deep dive is to step back and synthesize, because when you look at individual data points today, a tech stock rally here, a bond market crash there, a weird new startup raising billions, it just looks like pure chaos. It just feels like noise. But when you layer the geopolitical data, the macroeconomic data, and the raw technological advancements on top of each other, a very clear, very startling picture starts to emerge. We are tracking a massive slow motion collision. The two extremes are finally hitting each other. On one side of the planet, you have the digital utopia of artificial intelligence racing at breakneck speed towards actual superintelligence, and on the exact opposite side, you have the hard physical reality of a breaking macroeconomic system. The digital force of the 21st century is slamming headfirst into a physical wall that looks like the 1970s. So let's unpack this, right? Because we aren't just going to stay up here in the clouds talking about high-level economic theory today. We have to get into the actual behavior. We are going down into the weeds, looking at the very specific, sometimes downright bizarre human behaviors and hard data points that prove this global shift is actively underway. Human behavior is really the ultimate tell. To truly understand where global capital is moving, you have to look past the spreadsheets, to be honest. You have to look at the weird, the unexpected ways people, CEOs, and massive financial institutions are reacting to this unprecedented stress. You have to look at what they do, not just what they put in their press releases. And the behavior right now is surreal. Let's dive right into the texture of this moment in time. We've got a handful of stories from this month that just perfectly capture the absolute weirdness of April 2026. So let's start in Washington D.C. with Polymarket. For those who don't follow it, Polymarket is the world's largest prediction market. It's a platform where you can bet on the outcome of real-world events. Up until now, it's been entirely digital, but they are opening a physical bar in DC. And not just a bar, they are explicitly designing it for what they are calling situation monitoring. Think about the mechanics of this for a second. Prediction markets used to be this niche, crypto adjacent thing, if you will, but they have rapidly morphed into what many in finance are treating as a new truth engine. Moving from a website to a physical brick and mortar bar right in the nation's capital, it shows that betting on geopolitical crisis and economic fallout has become a mainstream spectator sport for the political and financial elite. It's the normalization of perpetual crisis. And you have to wonder, what does this mean? Will it mean that politicians will just now bet on things they already know given the outcome and then make billions of dollars off it? Like, surely this is borderline insider trading, and that's got to be fixed. Anyway, what's fascinating here is the social dynamic. You have lawmakers, lobbyists, and hedge fund managers gathering in a physical social setting, ordering cocktails to watch and actively wager on real-time global anxiety. You have active traded contracts on whether Apple CEO Tim Cook will step down before 2027. You have live betting pools on the specific outcomes of kinetic military conflicts in the Middle East. It is the ultimate gamification of reality. So just picture the scene, right? People standing around a mahogany bar clinking martini glasses while looking up at a massive screen tracking the fluctuating odds of a CEO getting fired, or a supply chain collapsing, or a literal war escalating. It's dystopian, but it makes financial sense to them. Honestly, it points to a deeper desperation. People are starving for accurate signals in a noisy world. If the official government data, the traditional X-ray machine, is broken or people just don't trust it anymore, they are pivoting to trust the financial wisdom of the betting crowd. It's a search for narrative certainty. When the official narrative breaks down, capital flows to wherever a compelling new narrative is spun. And sometimes, just sometimes, investors are so desperate for a good story that they will completely ignore the spectacularly fraudulent history, which leads us perfectly into the rebranding of Trevor Milton. This situation is wild. For anyone who needs a refresher, Trevor Milton is the infamous founder of Nikola, the electric truck guy. Back in 2020, Nikola was this vaporware electric truck company that went public. At one point, based purely on hype, this company was worth more than Ford Motor Company, despite the rather crucial detail that they had never actually produced a functioning commercial vehicle. The whole thing unraveled when a massive short report came out. The smoking gun was a promotional video showing their revolutionary battery-powered semi-truck driving smoothly down a desert highway. It turns out the truck didn't have a working engine at all. They literally towed it to the top of a low-grade hill, let it roll down, and tilted the camera angle to make the road look flat. It was essentially a gravity-powered truck. Milton was ultimately convicted of securities and wire fraud. But that brings us to today, where the landscape has certainly shifted. Milton was recently pardoned by Donald Trump. The mechanics of how that happened involve Milton leaning heavily into a narrative of being a political victim, followed by him donating millions to the campaign. Just to be clear, we are just reporting the facts here, taking zero political stance on the pardon itself. We're just looking at the market mechanics. Setting aside the politics, what matters to the market is what happened next. Milton is immediately back in the game. He is now the CEO of a Utah-based company called Cyberjet Aircraft. And what is he pitching to investors? He claims he's going to create the first light jet focused on artificial intelligence flight. It is the ultimate buzzword salad, isn't it? Think about the absurdity of capital allocation right now. A man who went to federal prison for faking a $40 billion truck company by rolling down a hill is now instantly able to pivot and raise money for AI jets. How does an AI jet even work? Does the AI fly it or build it? It doesn't matter really. Honestly, it just proves that AI is the ultimate magic word to unlock capital. If you slap AI on your pitch deck, billions of dollars will blindly chase you regardless of your past. It is a textbook gold rush mentality, and whenever there's a gold rush, the grifters don't go away. They just set up their tents right next to the actual miners. But it's easy to mock the retail investors getting duped by vaporware AI jets. The truly terrifying structural risk isn't the grifters, it's what the sophisticated institutional capital is doing to itself in this gold rush, I mean, we need to look at the Beignet Investor LLC paradox. This is where the financial engineering gets incredibly ironic. Blue Owl is a massive player in the private credit space, which is basically a non-bank lender. They pool money and lend it directly to companies. So, Blue Owl sets up a special purpose vehicle to ring-fence a specific massive investment. They gave this SPV the hilariously folksy name of Beignet Investor LLC. It sounds like a little boutique bakery down in the French Quarter of New Orleans. It was decidedly not a bakery. Through the specific SPV, Blue Owl raised an absolutely staggering $27.3 billion. Just pause on that number, $27.3 billion in a single vehicle. What on earth requires $27 billion of private credit? The answer is data centers. Specifically, it's financing Meta's Project Hyperion data center build-out down in Louisiana. To understand why this is a massive paradox, you have to look at the history of private credit over the last decade. Private credit firms grew into behemoths primarily by lending hundreds of billions of dollars to traditional software-as-a-service companies. If you build a B2B software tool, you charge a monthly subscription that creates incredibly stable, predictable, recurring revenue. Stable EBITDA. It was a lender's dream. Private credit funds loved this because it was like lending against a bond. You loan a SaaS company $500 million and you know exactly how much cash flow they have coming in every month to pay your interest. So private credit's entire existing loan book, their very foundation, is built on the survival and stability of those traditional SaaS companies. But now those exact same credit firms are aggressively pivoting. They are raising tens of billions of dollars like this Beignet SPV to fund massive AI data centers for companies like Meta. But what are those data centers actually doing? They are training frontier AI models. And what are those models explicitly decide to do? Write code, build interfaces, and manage workflows. They are designed to completely obliterate the traditional SaaS business model. This is the paradox. Private credit is literally financing its own executioner. Can you believe that? They are handing over billions of dollars to build the technological weapons that will render their existing loan portfolios almost completely worthless. If AI agents successfully kill the traditional middleman business model, those SaaS companies lose their recurring revenue. If they lose their revenue, they default on those hundreds of billions in private credit loans. It's an Ouroboros. The snake is eating its own tail and Wall Street is happily financing the meal. The private credit guys are chasing the AI heels today, entirely ignoring that they are funding the destruction of their collateral from yesterday. It's short-term greed blinding them into long-term structural risk. It's an abstract structural anxiety, but this anxiety isn't just staying in the spreadsheets, it's bleeding into the physical world in very dark ways. Look at the anti-AI home invasion. This one is chilling because it brings a very grim human interest angle to the macroeconomic data. We are seeing reports of a 20-year-old suspect being arrested for targeting the physical home of OpenAI CEO Sam Altman. When you dig into the motive, it wasn't a standard burglary. The suspect didn't want to steal a TV or a laptop or even a watch. The stated motive was a genuine, deeply held belief that artificial intelligence is going to lead to human extinction, and he wanted to physically stop it. It proves a fundamental shift in the culture. The societal anxiety around superintelligence is no longer confined to fringe internet forums or philosophical debates on Reddit. It is manifesting into real-world kinetic criminal behavior. People are terrified. The transition to an AI-driven world is moving so fast that it's introducing genuine psychological panic. People feel helpless against the code, so they attack the physical infrastructure of the people building it. You take all these textures together, you have the DC elite drinking martinis while betting on global collapse. You have convicted fraudsters effortlessly raising money for AI jets, and you have Wall Street credit funds blindly financing the destruction of their own industry, and you have a 20-year-old trying to physically assault the CEO of OpenAI to stop the apocalypse. When you layer these behaviors, you start to see the spine of our story today. The overarching thesis here is what we can call the bifurcation of the intelligence age. We are witnessing the jarring, violent intersection of an unstoppable technological force colliding with an immovable macroeconomic object. The digital dream versus the physical reality. On the digital side, you have the tech giants racing towards artificial superintelligence, or ASI, at a pace that is breaking models every 6 months. On the physical side, you have a global economy choking on stagflation, surging commodity prices, and massive physical infrastructure constraints. And let's connect these dots going straight from the code to the concrete. The tech giants aren't hiding their ambition anymore, they are sprinting towards superintelligence. Sam Altman authored a 13-page public policy document for OpenAI, essentially pitching Washington D.C. on a completely new social contract. It's a breathtaking document. He's explicitly telling the US government in writing that the technology his company is building is going to fundamentally break the current economic system. The proposals in that document are staggering for a tech CEO. He's asking the United States to prepare for superintelligence by adopting massive sovereign-style wealth funds. He uses the Alaska Permanent Fund, which pays dividends to residents based on oil revenue, as his model, except instead of oil, the fund would be seeded by equity in AI firms, paying a universal basic dividend to every American. He is also calling for a mandated 4-day work week, and most shockingly, he's proposing a national tax on robot labor. Now, my cynical arm belts definitely ring here. Why would the CEO of a leading AI company in the world proactively beg the government to tax his own technology and redistribute his wealth? It sounds like a PR stunt to look like the good guy, but you have to look at the underlying assumption. You only propose a tax on robot labor if you genuinely believe robot labor is about to completely displace human labor at scale. He isn't pitching this out of altruism, he's pitching it out of self-preservation. If AI actually destroys the middle-class labor market, who buys the products? Who pays the mortgages? Societal collapses. Essentially, he's trying to build a state-sponsored life support system for the consumer economy funded by AI so that society he operates in doesn't implode into revolution. So the ambition is total economic transformation, but here is the friction. To build this digital utopia, to actually achieve superintelligence, they need compute. They need unprecedented amounts of GPUs, and GPUs require massive physical data centers. Data centers require incredible amounts of physical space, water for cooling, and most important, raw energy. Code ultimately requires concrete. It requires copper wiring, it requires electricity, and this massive need to scale up physical infrastructure is happening at the exact worst time in modern history, both geometrically and geopolitically. Let's look at the map, right? So the Middle East is currently engulfed in expanding conflict. The US has initiated operations, there are direct attacks involving Iran and the Strait of Hormuz. The choke point for global energy is under severe threat. This geopolitical reality is driving energy prices through the roof. Brent crude oil has surged 48%, pushing well past $100 a barrel. Expensive oil acts as a massive unavoidable tax on the entire physical world. It drives up inflation across the board. Every supply chain, every truck delivering steel, every piece of physical material needed to build these AI data centers suddenly costs significantly more. And how do central banks fight that inflation? They keep interest rates high. That keeps bond yields punishingly high. The 10-year Treasury yield has spiked 10%, hitting 4.412%. So borrowing money to build things is incredibly expensive right at the exact moment that the tech industry needs to borrow hundreds of billions of dollars to build out that AI infrastructure. It's the ultimate financial squeeze. High interest rates crushing borrowing capacity, combined with high commodity costs crushing physical margins. And who gets squeezed the hardest? The corporate middle class. It's an interesting one because higher interest rates mean higher bond yields, and higher bond yields mean higher risk-free rates, which means that valuations decline because your discount rates have decreased as well. Your valuations have decreased because your discount factors increase. Essentially your denominator is increased. So you're essentially devaluing things because of the environment we're in, but at the same time everything is skyrocketing. Anyway, having said that, the traditional SaaS companies, the human middle management layer, they are being pulverized. The money in the system is completely bifurcating. It's hollowing out the center. It's following rapidly away from the middle and clustering at the extremes. It either goes into hard physical commodities to protect against inflation, or it goes into hypergrowth of massive AI infrastructure, which then brings us back to the broken diagnostic machine, right? The system wasn't built to handle those two extremes at the same time. I mean, imagine trying to run a futuristic magnetic levitation bullet train. The software engine is a marvel of engineering that wants to move at light speed, but the only tracks you have available to put this train on are 19th century splintering wooden rails. It's going to tear the tracks apart. The software is completely bound by the friction of the physical world. It's bound by copper shortages, aging energy grids, and global supply chains that are literally on fire. The software is ready for the 22nd century, but the macroeconomy is dragging it violently back to stagflation of the 1970s. That friction between the maglev train and the wooden tracks is where things physically break. And we have hard evidence of both this towering ambition and this grinding friction right in front of us. So let's look at the specific moves being made by the key figures in the market. We just discussed Altman's utopian public policy document, but the private reality inside OpenAI is dramatically messier. There was a massive investigation published recently drawing on over 100 internal interviews. It surfaced leaked memos from Aya Satskiver. Sorry, I'm probably butchering that name. But anyway, she's the former chief scientist at OpenAI, along with private notes from Dario Amodei, another early figure who left to found Anthropic. These aren't disgruntled low-level employees. These are the foundational technical architects of the AI revolution, and their internal communication allege a long-running, documented pattern of deception. Satskiva's memo are built from 70 pages of internal Slack pages and HR documents. He explicitly claims that Altman routinely mispresented safety protocols to the board of directors. Amodei's private notes reach the exact same conclusion, writing, "The problem with OpenAI is Sam himself. It gets to the point where a senior Microsoft executive, the company that poured tens of billions into OpenAI, is quoted saying there's a small but real chance Altman is eventually remembered as a Madoff scammer." You just have to sit with that dissonance for a moment. On one hand, you have the CEO standing in front of Congress pitching a utopian national wealth fund to save humanity from the very product he's building. On the other hand, his closest technical co-founders are spending months documenting internal deception and warning that he cannot be trusted with the safety protocols of superintelligence. It's terrifying. It exposes the incredible, almost unbearable tension and pressure at the very top of this arms race. So, if the guy building the software engine might be cutting corners on the safety brakes, why are the other tech giants doing? Or what are they doing really? I mean, let's look at Jeff Bezos, the guy who built the ultimate digital storefront. Is he building a new generative AI app to compete with ChatGPT? No. Bezos is looking straight at the wooden tracks. He sees the physical bottleneck. Reports indicate he's raising a staggering $100 billion fund for a highly secretive startup project called Project Prometheus. And where is he deploying the $100 billion? He's buying physical manufacturers, legacy chip fabrication plants, defense contractors, and aerospace manufacturers. If AI is truly this magical superintelligence force, why is one of the smartest capitalists in history buying metal stamping plants and old airplane factories? Because it's precisely being AI algorithms are increasingly becoming commoditized or open source. Anyone can spin up a decent language model now. The moat is shrinking. The real scarcity in the future isn't the code. The scarcity is the megawatts required to run the code. The scarcity is the physical silicon, the cooling systems, the aerospace chassis that the AI will be installed in. Bezos isn't betting against AI. He's buying the toll booths on the only physical road that AI has to travel down. He's buying the wooden tracks so he can charge the bullet train rent. He sees that software margins will compress to zero, but physical hardware monopolies will print cash. Meanwhile, what's happening at the corporate operational level, you may ask? I mean, look at Jack Dorsey over at Block. He is executing what he explicitly calls the case against managers. Dorsey is betting that AI can completely eradicate the bloated legacy middle management layer of his company. Think about the daily life of a middle manager. They check gyro tickets, send follow-up Slack messages, route approvals. For the last 3 years during the pandemic, every single one of those interactions was digitized. Remote work generated the perfect telemetry data. The managers literally trained their own replacements. Dorsey's thesis is that AI can ingest all that remote work data and autonomously manage the workflow. You don't need a human making $150,000 a year to ask an engineer if the code is done. The AI agent can check the repository, see it's done, and automatically route it to quality assurance. Dorsey is actively hollowing out the human management layer. And as the labor force shifts, how is the pure financial capital shifting? Look at Larry Fink, the CEO of BlackRock. He recently published his annual letter and explicitly compared the current state of crypto tokenization to the internet in 1996. He's recognizing that the fundamental plumbing of capital is evolving, and BlackRock isn't just writing letters, they are actively holding massive amounts of Bitcoin through their current market dip and buying up infrastructure assets across the crypto ecosystem. So you have the smartest money in the world, the billionaires and the mega funds holding physical manufacturing monopolies. They are aggressively firing human middle management and buying non-sovereign digital assets like crypto. They are abandoning the traditional corporate middle. And the hard data from the broader market absolutely proves that the traditional system is breaking under the pressure. I mean, look at the S&P 500. The technicals are incredibly ugly right now. The S&P broke decisively below a massive psychological and technical support level of 6,500 and is currently sitting around 6,350. There is a brutal 9% drop just since the onset of the latest conflict escalation in the Middle East. It just recorded its worst single month in over a year. And the Nasdaq has officially entered a correction, down over 10% from its all-time highs. But the real screaming alarm is in the commodity squeeze in the bond market. We mentioned Brent crude is up 48%. That makes sense in a war, right? But here's the bizarre anomaly. Gold experienced an unusual 16% sell-off at the exact same time. War breaks out, oil spikes, inflation drops, and gold drops 16%. It breaks every rule of macroeconomics. Gold is the ultimate fear trade. If the world is burning, people buy gold. Why did it suddenly puke? You have to think about the mechanics of the market liquidity and margin calls. When tech stocks and government bonds crash simultaneously, massive institutional funds suddenly find themselves underwater. The prime brokers demand cash to cover losses right now, a margin call. And when you get a margin call, you don't sell what you want to sell, you sell what you can sell. Gold is highly liquid, so these funds dump their gold even in a crisis, just to raise cash to cover their burning tech and bond portfolios. It's a liquidity cascade that shows you how distressed the internal plumbing of the market really is. The bond market is feeling that same distress. The 10-year treasury yield spiked up 8 basis points to 4.412%. It is a textbook stagflationary storm, and even the untouchable tech giants are starting to feel the financial gravity. Look at Meta. We talked about that $27.3 billion private credit raise for the data centers earlier. You'd think their balance sheet would be bulletproof, but the capital expenditure required to build these AI models is so astronomical that even with that massive debt raise, Meta is only covering about 20% of the total projected costs. Their free cash flow is projected to go entirely negative in 2027 and 2028 because of this AI build-out. They are bleeding cash just to stay in the race. And how does this massive macro squeeze impact the everyday economy? The job market disconnect we talked about is happening in real time. We have specific examples of AI agents completely displacing human logistical roles. There's an AI agent called OpenClaw that is currently autonomously checking Toyota dealership inventory. If a dealership needs a specific RAV4, a human used to have to call 10 different dealerships, negotiate a trade, and arrange transport. It took hours, sometimes days. Right now, OpenClaw autonomously accesses the inventory APIs of every dealership in the state, locates the exact VIN number, drafts the paperwork, and pings the transport logistics system all in 3 seconds. The human logistics coordinator is gone. AI is taking over coding syntax, handling customer service, even scoping advanced physics research. The human managerial layer is being hollowed out faster than the labor statistics can track it. So we have the diagnosis, the system is bifurcating, the middle is collapsing, and capital is fleeing to the extremes. The $1 million question is, how do you actually invest in this environment? I mean, what is the strategy when the traditional 60-40 portfolio, that negative correlation between stocks and bonds that protected retirees for 40 years, has fundamentally broken? The data points to a very specific aggressive approach, the barbell strategy. I mean, imagine a physical barbell. You put zero weight in the middle. On one end, you load up on hard physical assets. On the other, you load up on hyper digital infrastructure. I mean, let's break this down into 4 technical parts that create a risk radar. But A is follow the whales. What is the truly smart institutional money doing while retail investors are panicking? As we discussed with Bezos, the smart money is abandoning traditional software and buying physical monopolies. Whoever own the physical constraints control the AI revolution. But then let's look at the other side of the barbell. Retail investors are panic selling their Bitcoin right now because of geopolitical fears. But the whales, the sovereign wealth funds, they have diamond hands. Massive institutions like BlackRock and Morgan Stanley are accumulating Bitcoin incredibly aggressively. Bitcoin's 200-day moving average is acting as a massive floor, just under $600 every time the price dips. Just under $60,000 every time the price dips. Sorry, I just got a little bit confused with my notes there, but essentially, if you don't know this, the 200-day exponential moving average is the golden thread of the market. This is something traders and investors monitor closely, and currently Bitcoin is under its sort of 200-day moving average, and every time the price dips, these massive institutions are stepping in and buying everything available. Morgan Stanley is literally launching a competing ETF right now, which specifically undercuts BlackRock's fees. Just a few years ago, the heads of these banks were calling Bitcoin speculative garbage. Today, there is a full-blown cutthroat institutional war to acquire and hold it. So the whales are hoarding physical monopolies and non-sovereign digital assets. That brings us to part B of the strategy, the hard and the hyper. These are the assets you want to hold on either end of the barbell. Defensively, you want hard assets that serve as structural insurance against currency debasement and stagflation. Gold has traditionally been that asset. Now there is a highly speculative theory circulating the US government could actively use gold to control inflation by artificially repricing it much higher. If inflation from $100 oil becomes untamable, the government could declare a massively higher fixed price for the gold held on its own balance sheet. If they revalue their gold reserves from $2,500 an ounce to $10,000 an ounce overnight, it instantly creates trillions of dollars of new equity without printing a single new dollar. It sounds like a desperate magic trick, but in a sovereign debt crisis, every extreme macroeconomic maneuver is on the table, and sitting right alongside gold as a defensive asset, you have Bitcoin. The institutional thesis frames Bitcoin as a non-sovereign safe haven during the decline of Pax Americana. If global trust in on the US dollar wanes, global capital desperately seeks assets that exist outside of any single nation's sovereign control. Now, let's look at the offensive side, right? The hyper side, the digital infrastructure. If there's a gold rush, don't mine for gold, sell the shovels. The pick and shovel plays for the AI era, and sovereign hardware, data center constructions, and defensive tech are what we are seeing is private credit giants like KKR and Carlyle Group pivoting to build massive data centers specifically contract for the US Army and Department of Justice. Anthropic has launched Project Glasswing, a defensive cybersecurity coalition for national infrastructure. When national security merges with AI infrastructure, budget constraints evaporate. The government checks always clear regardless of interest rates. Part C of the strategy is arguably the most critical for survival, the kill zone, the shorts. What business models are actively going to zero? It's the disrupted business model, specifically traditional middleman SaaS companies. If you run a company whose entire product is just providing a nice B2B interface, you are dead walking. Even AI agent can ingest raw data, write custom code, verify results, and manage deployment autonomously. Why does the client need to pay you hundreds of dollars a month for your interface? They don't, right? And the death of those SaaS companies leads us to private credit market, the ticking time bomb of 2026. Private credit lent heavily with floating interest rates or to those exact middleman companies, but now those SaaS companies are losing clients to AI and their borrowing costs are soaring. They default on the loans, right? And when the underlying loans start defaulting, the credit rating of the entire collateralized loan obligation gets downgraded, forcing massive pension funds and insurance companies to legally sell them. It triggers a cascade of forced selling. Also sitting in the kill zone are hedged equity funds. As the overall market drops, automatic derivatives are triggered, forcing funds to programmatically sell more assets, which only exacerbates the crash. Which brings us to part D, the watch list. These are the systemic signals that tell you the financial plumbing is actually breaking. The first concept we absolutely need to watch is the yen carry trade unwind. The Bank of Japan kept interest rates at zero, so global hedge funds borrowed practically free Japanese yen, converted it to US dollars, and bought high-flying tech stocks. It was free leverage. But the fatal flaw is that if the Bank of Japan raises interest rates to protect their currency, the cost of that borrowed money spikes. Prime brokers issue margin calls and hedge funds have to dump their global assets just to buy yen to pay back the loans. Everyone rushes for the exit door at the exact same millisecond, causing a violent, disorderly global market crash, essentially a stampede. So you monitor the Bank of Japan obsessively, but the most terrifying macroeconomic signal on the watch list, the ultimate endgame scenario, is yield curve control. If the geopolitical wars drag on and deficit spending explodes, the bond markets break. If investors demand such high interest rates that the government literally cannot afford to pay, the Federal Reserve has to step in as the buyer of last resort. They intervene by printing trillions of dollars out of thin air to buy the bonds themselves, artificially capping the interest rates. Historically, when the Fed printed money, the physical world was abundant, but oil isn't cheap right now and supply chains are completely fractured. So, if the Fed prints trillions while physical commodities are severely constrained, that printed money has nowhere to hide. It instantly inflates all physical input costs simultaneously. The price of food, energy, rent, transportation all violently reprice upwards. And what does this do, you may ask? It will lead directly to a hyperinflationary sovereign debt crisis, stagflation on absolute steroids. Think Zimbabwe. Your wages stay flat, your job is threatened by AI, and the cost of everything you need to survive doubles. And that grim reality brings us full circle back to superintelligence. It contextualizes Sam Altman's policy document. He is defining superintelligence as a system so advanced that it fundamentally breaks the current macroeconomic model of exchanging human labor for capital. He is saying human intellectual labor will be devalued to practically zero, and if human labor is worth zero, humans can't earn money to participate in the economy. This is why his definition necessitates taxing robot labor and creating sovereign wealth funds. It is state-sponsored life support required just to pay universal dividends so citizens can survive. So, what does this all mean for you? Whether you are a founder, a retail investor, or just a professional trying to navigate your career, the diagnosis is abundantly clear. The era of coasting on middleman skills is officially over. You can no longer just be an interface. To survive this bifurcation, you have to move to the extremes of the barbell. You have to either own the hard physical assets that anchor reality, or you have to radically adapt to managing, directing, and owning the AI agents that are currently automating the labor. And I want to leave you with one final thing in mind. Essentially, one final mind-bending paradox to mull over as you go through the week. Through a robust consider the human element. The software engineers, they're brilliant, highly paid software engineers working tirelessly right now at places like OpenAI, Anthropic, and Meta. They are utilizing billions of dollars of private credit debt to build these frontier AI models. They are literally, keystroke by keystroke, writing the code that will make their own highly lucrative coding professions entirely obsolete. And the efforts are being funded by debt that is actively destabilizing the broader software industry that used to employ them. They are building the engine that will run them over. As we come to a close, I want you to think back to that broken diagnostic X-ray machine we started with. We used to be able to look at a career path or a tech trend or a stock chart and see a clear, jagged white line of cause and effect. But that machine is unplugged now. The digital utopia and the physical reality have collided, and the diagnostic tools are shattered. The diagnosis is murky, but the shift is undeniably real. You have to look at the human behavior, follow the whales, and respect the physical limits of the world. Thank you for taking the deep dive with me. I will chat to you next time.